So, we are more or less through. Now the wrap up. What you heard today was actually about, and actually it should work. Yeah. What you heard about today were several things. How far are we with the strategy implementation, what we delivered, what the potential is to go on, that we achieve our midterm targets, and you got a lot of details which kind of work we do, because we are not a construction company. That's very important. These are the trends and drivers what we have. This drives our business, and there is no change visible in the next 20 years that we will see really an improvement on the volatility, that we see a real improvement on over-bureaucracy, that we see a real improvement on labor shortage as long as we are not moving the societies more digital, where governments have to invest more in infrastructure. There is a big task and a growing task for industrial service to take over more and more adjacent and non-core parts of our customers, that they can focus on that, what they actually would like to produce and to sell. That is already complicated enough. And we saw that before, actually in the digital or IT industry, where every company had their own people to install printers and laptops and software updates. In all professional bigger companies, this is completely outsourced, and outsourced to IT service companies. And it's a similar thing what we see in the industry. And on top of it, not only that we take that, we can make the life of the clients significantly better by earning more money with that what they have on existing assets, which is more than 90% of our work, and already in the planning, helping customers to plan it like that, that industrial service, that the maintenance, the turnaround is already factored in how you design everything what you have. And we prove that more or less daily on battery factories, on hydrogen. We actually do it when we change in district heating into a district cooling system like in Munich. A lot of that, we as an industrial service provider can do that. And as more offering we have, as better for the client it is. Because the combination of all the offering really brings the efficiency. And that is, of course, the thing that we can grow, and that we grow in an expanding market. We heard about the Middle East, we heard about North America, we definitely have pockets in Europe too, if it comes to green tech, for example. And we can grow in declining markets too, because customers are forced to outsource more to focus on that what is essential for them. A company which does this kind of work 3,000, 4,000, 5,000 times is always better than a company doing it on their own 2 or 3 or 5 times on their own sites. And that's the card to play. And that is for us as a group, will drive further shareholder return and shareholder value, which is important. And we have a hell of a good way to go. There is a lot more in the company than we saw, because we delivered, no matter if it's functional organization, efficiency program, strategy update, whatever it is, you can see it in the figures. When you look through the material, you can link the strategic successes, what we have in the strategic levers with the figures. And that is how we will be transparent to the future too. On the other side, market starts to recognize more and more. There are the MDAX, media, the last negative comment we got on media, which was for Bilfinger for quite a while, regular that we got that. The last negative comment on media about us was in November 2022, actually when we announced the efficiency program. So out of that, the attractiveness on growth, and then the attractiveness on profitability, the attractiveness on cash generation, the attractiveness to be the #1 in the eyes of the clients for industrial service. That is what we actually showed today. The growth, what we have with the 4 to 5% in a market with 2% is a reasonable growth. On top of it, M&A, but if you project that to the future, significant more to come. That's how we see it. We were fairly clear and detailed how we are doing M&A and where we look into. And when you take the Stork acquisition, it took more than 1.5 years to realize it, not because the seller had problems to get rid of it or didn't want to sell it. It was actually us, which were very clear what we are intending to pay for and how it has to look like when we take it over. Because we look into value creation. And a pure strategic argument to buy a company because it fits strategically is not an argument. It has to create value. It has to fit into the company. Never ever buy a company where you think strategic it fits and the first thing what you have to do is to cut people because you recognize it's really not profitable enough or it doesn't fit or anything. Then why to do M&A? We are unbelievable simple, unbelievable crystal clear what we want. Why are we so crystal clear? Because then the offers what we get from the industry, from owners and other companies is already significantly easier to dwell than if you only go out and say we want to do M&A, because then you are bombed with whatever you can't imagine with what, and you don't want to have that. So out of that, Matti will make the wrap-up for the financial.
Yes, thank you, Thomas. So we took you back to the last Capital Markets Day where we issued our midterm numbers with an intermediate step in 2024, 5% EBITDA this year, 70% cash conversion, 6 to 7% profitability in the midterm, and over 80% cash conversion thereafter. A big lever in achieving that cash conversion is working capital management and improving that, and I think I explained that quite in detail. I think the takeaway here really is measuring average net trade assets over revenue. It's a simple measure, easy to understand, comparable to a lot of other businesses and companies and peers. So we will take that from 12% down to 8% in the midterm with de-risking, automation, competence development, and so forth. The outlook, and I removed the previous outlook that we gave earlier this year, so it's easy to remember, 4.8 to 5.2 billion euros, 4.8 to 5.2% on the EBITDA margin, 100 to 140 million euros on the free cash flow, including the special items payout from the efficiency program. If you do that, then the cash conversion rate adjusted comes to 70%, which is what we promised 16 months ago. Finally, capital allocation, no change, very solid. This is what we deliver, increasing profits, increasing dividends. We're funding our organic growth, we're funding M&A, and last but not least, if share buyback makes sense, it's in the cards. All of this based on a good, sound balance sheet, a good and sound financial policy, and investment grade rating, as I said earlier, is hopefully around the corner. With that, I think there's the last wrapping up the wrap-up.
So that slide, if you think about us, that slide actually should always appear. And that is minimum what we tell all our colleagues. And it shows actually the way forward, our journey where we are on. We promised something on the Capital Market Day in 2023, where we start here on that graph. And we delivered what we promised, partly a little bit more. And we will deliver for this year, as we promise. And we will definitely deliver the midterm targets. And what comes after is potential. The industry supports us, no matter if they are under pressure or not, or expanding. And how we are set up with the bundling, de-risking, offering from projects to products, we get more and more positive feedback from our clients, and actually a lot of pressure, you heard that from the segment colleagues, to go with them around the world. And from time to time we have to say no, because it's too far out. And from time to time we say, maybe, and let's look into it, how it works out. But the attractiveness of us is fantastic. It makes it really fun to work in Bilfinger.